California lawmakers called this contract a massive hidden ball trick, but it's actually a masterclass in financial engineering involving $680 million in deferred payments. While the headlines screamed $700 million, the real story lies in the fine print that terrified the California State Senate. We are going to break down the exact mechanics of Shohei Ohtani's contract, the federal law specifically for USC SAC 114 that makes it legal, and the specific tax strategy that could save him nearly $100 million. Most people see a baseball contract. The IRS sees a sophisticated derivatives trade. Here is how the numbers actually work. If you look at the revenue waterfall visual of this deal, you immediately see a stark, almost absurd contrast. On one side, you have Ohtani's liquid salary, $2 million annually for 10 years. On the other side, you have a massive dam holding back $680 million, which only releases starting in 2034. This structure is why the Major League Baseball Players Association calculated the present-day value of the deal at roughly $460 million, not the headline $700 million figure. This valuation discrepancy relies on the time value of money. A dollar received in 2034 is worth significantly less than a dollar received today, due to inflation and lost investment opportunity. When you analyze the deferred $680 million, you notice a critical detail. It is paid out without interest. Ohtani effectively agreed to let the Dodgers hold that capital for a decade for free. By the time he receives the final installment in 2043, inflation will have eroded a substantial percentage of that money's purchasing power. If inflation averages just 3% over the next 2 decades, the real value of those future payments drops by nearly half. However, Ohtani can afford this erosion because of the endorsement layer in his revenue waterfall. Unlike a standard player who needs a bi-weekly paycheck to fund their lifestyle, Ohtani generates an estimated $50 million annually in off-field income from partners like New Balance and Seiko. This external revenue stream subsidizes his artificially low liquid salary during his playing years, allowing him to treat the Dodgers contract as a long-term savings vehicle rather than a checking account. For sports executives, this structure demonstrates how deferrals function as an interest-free loan from the player to the team. By deferring 97% of the money, the Dodgers freed up immediate cash flow to sign other stars like Yoshinobu Yamamoto, essentially using Ohtani's own capital to build a championship roster around him. The team saves on cash flow, but Ohtani's real win isn't about interest, it's about where he lives when the checks finally clear. To understand the magnitude of this strategy, look at the tax scenario map. California currently imposes the highest state income tax in the nation, with a top marginal rate that fluctuates between 13.3% depending on specific surcharges. In contrast, states like Florida, Nevada, Texas, and Tennessee have a 0% state income tax. The gap between paying 14.4% and 0% on a $680 million payout is the entire basis of this financial play. This is where 4 USC Power Act 114 comes into play. This federal statute, often referred to as the source tax law, prohibits states from taxing the retirement income of non-residents if the payments are structured in a specific way. The law states that if deferred compensation is paid out in substantially equal periodic payments over a period of not less than 10 years, the state where the money was earned, in this case California, cannot tax it once the recipient establishes residency elsewhere. Ohtani's contract is not random, it is mathematically precise. The deferred payments are spread exactly over 10 years, from 2034 to 2043. Because the payout period meets the 10-year threshold, the IRS views these payments similarly to a pension plan. If the contract had paid out over 9 years, California would retain the right to tax every dollar. By extending it to 10, the income becomes portable. Let's calculate the specific math on this arbitrage. If Ohtani remained a California resident while receiving the $680 million, the state would claim approximately 13.3% for the general fund and an additional 1% for the mental health services tax on income over $1 million. That totals roughly 14.3%. On $680 million, that tax bill comes out to approximately $98 million. However, the residency play timeline is strict. To trigger this exemption legally, Ohtani must establish a bona fide domicile outside of California before January 1, turning 34. If he moves to a condo in Miami or returns to Tokyo before that date, California gets 0. Financial planners and agents should note that Section 114 compliance requires rigid adherence to the substantially equal periodic payments rule to qualify for source tax exemption. You cannot front-load the payments or add lump sum balloons. The structure must be uniform to mimic a pension. This loophole is so effective that it triggered immediate panic in Sacramento and comparisons to historic contract anomalies where players outsmarted the system. To see how aggressive this is, compare it to the most famous deferral in history, Bobby Bonilla. The New York Mets bought out Bonilla's $59 million contract in 2000, agreeing to pay him annually until 2035. But Bonilla negotiated an 8% interest rate, turning that $5.9 million into nearly $30 million. Ohtani did the opposite. He took 0% interest. This crucial difference maximizes the principal deferral, allowing him to shift the bulk of the money into that tax-free window we just discussed. If he had taken interest, that interest would be taxable as it accrued, defeating the residency play entirely. Then look at Max Scherzer's deal with the Washington Nationals. Scherzer deferred 50% of his $200 billion contract. This was the modern bridge to the Ohtani deal, using deferrals to lower the team's immediate payroll burden without the extreme tax arbitrage. But for the residency strategy, the real peer isn't a baseball player, it's Lionel Messi. When Messi moved to enter Miami, the lack of state income tax in Florida was a calculated component of his compensation package, shielding his salary and endorsements from the high-tax jurisdictions he left behind in Europe. This pattern terrified California lawmakers. In response to the Ohtani deal, the California State Senate introduced Joint Resolution 14, urging Congress to cap these deferrals. They argued the structure creates a hidden ball trick that starves the state of revenue. However, as of 2026, this effort failed to gain federal traction. Why? Because Section 114 was designed to protect middle-class pensioners from being taxed by states they retired away from. Modifying Section 114 would essentially require dismantling the tax portability of almost every pension fund in America, a political non-starter. Federal lawmakers have little incentive to rewrite a law protecting millions of retirees just to help California collect tax revenue from one outlier athlete. The loophole remains wide open. The politics are messy, but for the Los Angeles Dodgers, the business logic is crystal clear. Let's grade this deal using a CEO scorecard on 3 specific metrics: cap management, cash flow, and brand ROI. First, cap management. We give this an A, or 10 out of 10. By deferring the money, the Dodgers lowered the contract's average annual value for the competitive balance tax, the luxury tax, from $70 million down to approximately $46 million. That accounting magic saved the team $24 million in annual luxury tax space. That is not just a rounding error. That is the cost of an entire starting pitcher like Tyler Glasnow. They utilized that savings immediately to stack the roster. Next, cash flow. This gets a B+, or 8 out of 10. Paying the best player in the world only $2 million in cash annually is a massive operational win. It frees up liquidity for stadium upgrades and operations. The only reason this isn't an A is the massive $680 million unsecured liability looming in the 2030s. The bill eventually comes due, and if the team is sold, that liability complicates the valuation. Finally, brand ROI. This is an emphatic A+. The Dodgers aren't just buying a designated hitter, they are buying an international media rights vehicle that monetizes a market most MLB teams cannot touch. Industry estimates suggest Ohtani generates over $50 million annually in additional revenue for the team through Japanese advertising signage behind home plate, merchandise, and ticket sales. Effectively, Ohtani's presence pays for his own contract before he even steps on the field. There is a risk factor here. If inflation spikes higher than projected over the next decade, those future payments become cheaper for the Dodgers to pay out, but costlier for Ohtani in terms of purchasing power. He is betting on low inflation. The Dodgers are hedged against high inflation. The ultimate lesson for general managers is that overpaying in total headline dollars is acceptable if the structure manipulates the average annual value to circumvent soft caps. The Dodgers secured a dynasty asset, and Ohtani secured a tax-free retirement fortune. The Ohtani contract isn't just a baseball deal. It is a complex derivatives trade where the player shorts California taxes and the team longs inflation. It effectively broke the model for how superstars are paid. If you want the full breakdown of how MLB luxury tax calculations actually work and how owners manipulate them, watch our deep dive on the Cohen tax next. Subscribe for more forensic breakdowns of the sports business economy.